Australian households brace for an interest rate shock. Hello everybody, my name's Leith Van Onselen, the Unconventional Economist, Chief Economist at MacroBusiness.com.au and the MB Fund, coming at you again with another macro breakdown, where today I want to talk about interest rate rises and what they mean for Australian households. Now, as I mentioned last video, Australian households are the second most indebted in the world, according to the Bank for International Settlements. And recently, economists have tipped that the RBA cash rate is going to rise from its current low of 0.1% by 1.25% over the next 2 years, whereas the markets are even more bullish, tipping that interest rates will rise from the current low of 0.1% by 2.5% over the next 2 years. Now, as we know, Australian mortgage rates have fallen significantly over the last 30 years, from a peak of 17% in the late 1980s to around 3.5% currently. In fact, over the pandemic, variable mortgage rates have fallen from 4.1% at the beginning of the pandemic to an average of 3.45% according to the RBA, whereas fixed rates fell from a pre-pandemic level of 3.08% to a low of 2.1%, but have since rebounded to 3.48%. So currently, fixed rates are above where they were pre-pandemic, whereas variable rates have continued to fall. Now, despite the 0.2% fall in variable mortgage rates over the past year, the typical new buyer of an Australian dwelling is now paying $407 more per month in monthly mortgage repayments than the same buyer would have done a year earlier. And this is purely because the median dwelling value, according to CoreLogic, has increased by $129,150. And of course, that increase in mortgage rates has been higher across markets that have risen more quickly, notably Sydney, Canberra, Hobart, and Brisbane. The situation's even worse for those with fixed rate mortgages. A person who bought a dwelling, the median dwelling in Australia in February 2021, on a 3-year fixed rate mortgage, was paying only $1,817 a month in monthly repayments. However, a median buyer in February 2022 using a fixed rate mortgage had to pay $2,609 per month in median mortgage repayments. That's a change of $792. So as you can see, it doesn't matter if a buyer's been variable or fixed, they've suffered quite a large increase in mortgage repayments in the year to February 2022, mostly because the median dwelling value has increased so much by $129,150. So what does this mean for the future? Well, if we take the February 2022 dwelling values as a guide, which comes from CoreLogic, and we take the starting interest rate of 3.45% coming from the Reserve Bank, what does it mean if mortgage rates rose by 1.25%, as predicted by the median economists, or 2.5% by the market? Well, if rates were to rise by 1.25%, from 3.45% to 4.7%, the typical borrower in Australia would be facing $422 extra mortgage repayments per month. Whereas if mortgage rates were to rise by 2.5%, as predicted by the market, mortgage repayments per month would rise by $874. Now, just to put that into percentage terms, if the median economist is right and mortgage rates rise by 1.25%, mortgage borrowers are looking at a 16% increase in monthly mortgage repayments. Whereas if the market's right and mortgage rates rise by 2.5%, median mortgage repayments are going to rise by 34% per month. That's a massive increase. The chart here on the right shows the increase in monthly repayments for each market under the two scenarios. Now, the Bank for International Settlements produces a quarterly data series called the debt servicing ratio, and what that does, that measures the percentage of household disposable income going into household debt repayments. And currently, the debt servicing ratio for Australia is running at early 2000 levels, having fallen significantly over the pandemic. However, if the median economist is right and mortgage rates rise by 1.25%, the debt servicing ratio will pick back up to around 2019 levels. Whereas if the market's right and mortgage rates rise by 2.5%, we're going to see the debt servicing ratio, i.e. the percentage of household disposable income going into debt repayments, rise to peak levels not experienced since the 2008 financial crisis. So either way, households are facing quite a significant rise in debt repayments, which also means a fall in household disposable income. It's also worth pointing out that fixed rate borrowers won't be spared either. According to the Commonwealth Bank of Australia, $500 billion worth of fixed rate mortgages are due to expire in Australia in the next 2 years, and all of these will have to be reset at the higher mortgage rate. The key takeaway from this analysis is that when the RBA begins to lift rates, well, it's going to have a marked impact on homeowners. And because Australians are so indebted, the RBA doesn't need to lift rates by much to have a very big impact. For this reason, I don't expect the RBA to lift rates by as much as either the economists nor the markets predict. For what it's worth, I'm tipping interest rate rises of less than 1%. Anyway, that's enough from me today. I hope you enjoyed the video. Please make sure to like the video, subscribe to the channel if you're new, and share it out. And I'll see you in the next video. Thanks very much for watching.